Welcome to the debate. For today's stock market result analysis for Thursday, June 18th, 2026, we examine, well, an unprecedented global market divergence.
Yeah, it's completely fractured out there today.
Exactly. Following U.S. President Trump's 60-day Islamabad MOU with Iran and, the Fed's hawkish rate hold, the tech-heavy SOX just surged. It was up 6.42% today, closing at 14,341.78.
While the traditional Dow basically just flatlined at 51,564.70.
Right, and Europe is completely split too. The UK's FTX 100 dropped 1.04%, but Germany's DAX rose 0.37%. This ended up dragging the U.S.Stock's 50, the SX5E, along with the French CAC 40 into slightly positive territory.
Yeah, while the broader U.S. market, like the S&P 500 and the Nasdaq 100, sort of rode the coattails of that SOX surge. Even the Wisdom Tree Dollar Index, the USDU, showed some, interesting volatility today.
It did. And look, I argue this divergence isn't a fluke. It represents a permanent structural shift in global capital allocation. Tech monopolies have entered a mature growth phase, right? Their massive cash flows make them, practically immune to the Fed's high interest rates.
Immune? I wouldn't go that far.
Well, highly insulated then. And look at Europe. The DAX and the CAC 40 are structurally benefiting from geopolitics. Trump's Islamabad MOU reopened the Strait of Hormuz, which immediately crashed Brent oil down to $78.07.
Right, which improves manufacturing margins for now.
Exactly. For heavy manufacturing economies, cheaper energy instantly widens their profit margins. So it's a structural reality, not just some herd mentality.
See, I look at that exact same data, and I see a massive behavioral overreaction. We are watching a textbook reflexive feedback loop. It's an irrational herd mentality driven by a highly fragile geopolitical truce.
Fragile? It's a signed MOU.
It's a 60-day truce. The tech sector right now is like a fortress built on a fault line. The UK's FTSE dropping is the real canary in the coal mine here. Their economy is actively breaking under the Bank of England's hawkish policies, which exposes the hidden, agency costs of prolonged high rates.
But the capital rotation is mathematically undeniable right now. Based on today's closing figures, our quant models project the Dow reaching toward 52,000 and the Nasdaq climbing past 31,000.
Right, but what about outside the U.S.?
It's the same story. Look at Korea. Fueled by the AI memory supercycle, the Kospi closed over 9,000. The Kospi 200 and the September futures, the F26909, are projecting to break new highs, targeting 9,550 for the main index.
I'm glad you brought up Korea, actually, because if you look at the other half of that market, the projections are grim.
You mean the smaller caps?
Exactly. High capital costs are severely pressuring early-stage companies that rely on cheap debt. The Kosdaq and the Kosdaq 150 are expected to plunge down to 945, and the Kosdaq September futures, the A0660901, are pricing in severe downside.
Well, they don't have the AI infrastructure monopoly.
Right, but it's not just them. Asian markets exposed to capital flight are suffering heavily. Chinese indices like the SSE Comp and SSE Comp, along with Hong Kong's Hang Seng and the HS Tech, are projecting massive drops. This proves the tech rally is just a reflexive echo chamber.
Which is exactly why a targeted quant trading strategy works so well here. Every month, you go long on the SOX and the Korean EWI ETF to capture that AI manufacturing dominance.
Okay.
And simultaneously, you short the FTSE 100 in Brent oil. You systematically ride the wave of cheaper energy benefiting tech while, minimizing exposure to struggling traditional economies.
I mean, I'm looking at your multi-asset long-short strategy, and it feels incredibly risky. If you're shorting Brent oil right now, aren't you essentially betting the whole farm that a fragile 60-day truce holds up?
It's a calculated risk based on the current data.
But options data shows institutional money is heavily hedging right now. For any monthly quant strategy in this environment, you must prioritize capital preservation.
So how do you trade it? Just sit on cash?
No, you use a hard money swap. We go long on gold,
which rebounded today to $4,283.14, and we short Bitcoin.
Short Bitcoin? Because it broke support at 62,000?
Exactly. Gold acts as your ultimate geopolitical hedge, while shorting Bitcoin protects against the drain of high capital costs. On top of that, you enforce a strict 1.5% value at risk limit. If Trump's 60-day truce shatters, the AI narrative won't save your portfolio from a systemic shock.
Well, we've certainly laid out two distinct realities today. Ultimately, the market is caught in a tug of war between an undeniable AI-driven infrastructure boom and the gravitational pull of prolonged high interest rates.
Yeah. The debate remains open on whether this 60-day truce will evolve into lasting macroeconomic stability or if we're all just pricing in a mirage.
We analyze with data, not intuition. Check it out together with a subscribe and like.